The trade that wears you down is often not the losing trade. It is the trade you entered because the market made just enough noise to make patience feel like ignorance. You saw movement, heard urgency in the price, felt the pressure of being left behind, and mistook activity for opportunity. That is one of the market's quietest costs. It makes a man pay not only with money, but with attention. A market does not speak in clean sentences. It sends waves, price waves, volume waves, rumor waves, emotional waves from other traders who are just as uncertain as you are. Some waves carry information. Some only carry fear. The difficulty is that both can look the same in the moment. A sudden rise can be genuine demand, or it can be late buyers chasing what stronger hands have already marked up. A sharp break can be the start of distribution, or merely the market shaking loose weak holders before continuing its course. Your task is not to react to every wave. Your task is to learn which waves deserve respect. There is a difference between price moving and price meaning something. That difference is where discipline begins. A stock can jump and still be unworthy of your capital. A market can fall and still be acting healthy. A quiet tape can be more important than a noisy one, because quiet periods often reveal who is willing to hold, who is losing patience, and where pressure is building beneath the surface. The trader who cannot sit through quiet will usually be forced to act during confusion. Noise becomes dangerous when it gives you a reason to abandon your own judgment. You had a level in mind, then price twitched and you moved it. You planned to wait for confirmation, then a candle expanded and you chased it. You knew the general market was weak, yet one strong stock tempted you into believing it was immune. Each decision may seem small, but the cause is the same. The market offered motion, and you accepted motion as evidence. This is why filtering is not a technical trick. It is a mental habit supported by practical observation. Before you act, notice where the move is occurring. Is it breaking from a sound base or lifting after a long, tired advance? Is volume confirming intention or merely showing excitement after the move is already obvious? Are leaders moving together, or is one name being pushed while the rest of the list refuses to follow? When traders are emotional, they crowd into the most visible action. When operators are serious, they often leave footprints before the public has a reason to cheer. The market's noise waves will always appeal to the part of you that wants certainty now. But the market rarely rewards the demand for immediate certainty. It rewards the trader who can separate pressure from signal and signal from temptation. That separation begins with accepting a hard truth: not every movement is an invitation. So before we speak of entries, exits, trends, and timing, we must first study the waves themselves, how they form, why they deceive, and what a disciplined trader should listen for when the market appears to be shouting. The first noise a trader must learn to filter is not on the chart. It is the noise that begins inside him the moment price starts moving without his permission. A stock rises after he decided to wait, and suddenly patience feels like a mistake. A position dips after he entered, and suddenly a normal fluctuation feels like a warning. The market has done very little, but the mind has already begun to argue. This is where many traders lose their balance. Not because they lack intelligence, and not because they cannot read a chart, but because they give emotional meaning to every movement. A small advance becomes proof that they are missing something. A small decline becomes proof that they are wrong. A quiet pause becomes proof that nothing is happening. The market offers motion, and the trader turns that motion into a private story. You must understand this clearly. Price movement and personal pressure are not the same thing. The market can move for reasons that have nothing to do with your plan, your timing, or your opinion. But when your attention is too close to every tick, you begin to feel as if the market is speaking directly to you. It is not. It is only moving. The danger begins when you treat that movement as a command. Noise becomes persuasive because it promises relief. If you are uncertain, action feels like relief. If you are afraid of missing a move, buying feels like relief. If you are uncomfortable in a position, selling feels like relief. The act may look like decision-making, but often it is only an attempt to end tension. And when a trade is taken to relieve tension, the market has already gained control over the trader. This is why impatience is so costly. It does not announce itself as impatience. It appears as analysis. It says, something is changing. It says, this time is different. It says, you need to act before it is too late. But beneath those thoughts is often a simpler truth. You do not like the feeling of waiting while price moves. The market knows how to create that feeling because movement is its natural language. The trader who cannot tolerate uncertainty will always be vulnerable to noise. He will seek confirmation before it exists. He will see danger before it is proven. He will find reasons to enter, exit, reverse, or adjust, not because the evidence has changed, but because his emotional temperature has changed. This is a serious distinction. When your mood becomes your signal, your judgment becomes unreliable. So the first discipline is not to silence emotion. That is impossible. The first discipline is to notice when emotion has become louder than evidence. Before you act, ask yourself what actually changed. Did the market violate something meaningful, or did it merely move? Did new information appear, or did your discomfort increase? Are you responding to a fact, or to the fear that a fact may soon appear? This habit creates distance. Distance allows you to see that every movement does not deserve interpretation. Some movements are only the market breathing. Some are only traders reacting to one another. Some are nothing more than pressure passing through weak hands. When you stop making every tick personal, you begin to recover the calm required to observe. A serious trader must protect his attention as carefully as he protects his capital. Attention spent on meaningless movement leaves less strength for meaningful judgment. The more you react internally, the more the market teaches you to depend on it for emotional direction. But the trader's task is not to be comforted by the market. His task is to remain steady enough to read it. That steadiness does not come from confidence alone. It comes from knowing the difference between a market that is giving information and a mind that is demanding certainty. Until you can separate those two, every wave will seem important, and every quiet moment will feel like a test. Once that inner noise is recognized, the next question becomes more practical when a real signal finally appears. How does a trader act without chasing, freezing, or turning discipline into hesitation? A trader can see the right thing and still do the wrong thing. This is one of the quieter lessons of the market. Recognition alone does not earn a profit. You may identify the better stock, notice the proper pressure building, and understand the direction of the tape, yet still damage the trade by acting without precision. The distance between seeing and doing is where many accounts are weakened. Execution is not excitement. It is not the rush of finally being correct. It is the moment where your judgment is tested against price, time, and risk. A signal may appear, but until you know exactly what must happen for you to act, the signal is only an observation. The market may be improving, but improvement is not yet a trade. Strength may be appearing, but strength without a prepared trigger often becomes an invitation to chase. This is why a serious trader does not enter because something looks interesting. He enters because the market has met conditions decided before pressure arrived. There is a level. There is a behavior. There is a point where the idea becomes active, and another point where the idea is proven wrong. Without those boundaries, the trader is not executing a plan. He is negotiating with movement. The danger of poor execution is that it hides inside good analysis. A trader can be right about direction and still lose because he entered where the risk was already stretched. He can be right about the stock and still fail because he bought after the easy advance, when the next reaction had become likely. He can be right about the general idea and still create a poor trade because he acted before the market confirmed the point he was waiting for. Correct opinion does not protect bad timing. You must separate preparation from action. Preparation allows thought. Action requires obedience. Before the trade, you may study, compare, and question. But when the chosen condition arrives, hesitation becomes its own form of noise. If you plan to act only at a defined point, and that point appears with the proper behavior, then the question is no longer whether you feel comfortable. The question is whether the market has done what you required. This does not mean rushing. It means removing confusion from the moment of entry. A clean execution has three parts: the reason for entry, the price behavior that confirms the reason, and the point that cancels the reason. When these are known in advance, you are less likely to buy because a candle is large, less likely to wait until the move is obvious, and less likely to adjust your decision simply because the market is moving quickly. There is also a discipline in refusing trades that almost qualify. Almost is one of the most expensive words in speculation. Almost breaking out, almost confirming, almost holding the level, almost showing strength with the group. These situations tempt the trader because they resemble opportunity, but they do not carry the same authority. When you act on almost, you accept the risk of a real trade without demanding the evidence of one. The market will often move near your price and then turn away. It will begin to confirm and then fail. It will show strength in one moment and hesitation in the next. This is not unfair. It is the normal testing ground of execution. Your job is to let the market come to the point where the trade is justified, not to pull the trade forward, because you want participation. A trade taken too early is usually defended too emotionally. A trade taken too late is often abandoned too quickly. The best execution feels plain. It may not feel dramatic. It may not give you the pleasure of catching the exact low or announcing perfect foresight. But it gives you something more valuable, a trade entered for a reason that can be examined. If the reason succeeds, you know why you are in. If the reason fails, you know why you are out. This clarity is the practical edge of disciplined action. Once a trader understands that execution must be precise, another truth comes forward: every unnecessary action carries a cost, and those costs do not remain small when repeated over time. Noise is expensive because it rarely looks expensive at first. One extra trade seems harmless. One small commission, one small spread, one small loss, one small slip in price. None of it appears large enough to matter. But the market does not punish only through single disasters. It also punishes through repetition. A trader can bleed away his advantage one unnecessary decision at a time. The mathematics of noise begins with frequency. The more often you trade without a real edge, the more often you expose yourself to cost. Every entry must overcome the spread. Every exit must overcome the same friction again. Slippage appears when the price you wanted is not the price you receive. Fees, however small, become a steady drain. The trade may begin as an opinion, but once executed, it becomes arithmetic. This is why activity can deceive a trader. A busy day may feel productive, yet the account may be doing nothing but paying rent to the market. 10-week trades do not become strong because they are managed with energy. If each trade has little advantage, the number of trades does not improve the situation. It worsens it. Repetition magnifies whatever quality is present. If the edge is sound, frequency may help. If the edge is absent, frequency becomes a machine for loss. Expectancy is the quiet judge. It asks a plain question after many trades: what does this behavior produce? Not what did the last trade do. Not whether one quick profit felt good. Not whether the trader was right for a moment. Expectancy measures the habit over a series. If your average win, average loss, win rate, and cost of execution do not support the action, then the action has no business becoming routine. A trader may think noise only creates losing trades, but that is not true. Sometimes a noisy trade wins. That is where the danger deepens. A random profit can train the trader to repeat an action that has no mathematical strength. The money feels like confirmation, yet it may only be luck arriving before consequence. When a poor trade wins, it can become more harmful than a poor trade that fails, because it teaches confidence in a weak process. This is the hidden tax. Noise increases the number of decisions without increasing the quality of those decisions. The account then faces more chances to be wrong, more chances to pay friction, and more chances to give back attention to marginal situations. Even when losses are small, the total effect can be heavy. A trader who loses a little too often may not feel reckless, but the account will still record the arithmetic. You must learn to measure not only profit and loss, but usefulness. How many trades were taken because the setup had a genuine advantage? How many were taken because price moved just enough to invite involvement? How many trades would you remove from your record if you judged them before knowing the outcome? This is where the mathematics becomes honest. The result of one trade can flatter you. The pattern of many trades will not. There is also a difference between risk and waste. Risk belongs to a trade with a defined advantage. Waste belongs to a trade that merely consumes capital, cost, and attention without improving the odds. The market requires risk from every speculator, but it does not require waste. Noise persuades the trader to confuse the two. He believes he is participating in opportunity when he is simply increasing turnover. So the practical lesson is to make noise visible in your numbers. Track the trades that came from clean conditions and separate them from the trades that came from marginal movement. Compare the average result, the holding quality, the cost, and the emotional effort required. Over time, the account will show you which actions earn their place and which actions only create motion. What cannot justify itself across a series should not be defended because it felt compelling in the moment. Once you see noise as a tax on expectancy, market movement begins to look different. The next question is not merely whether price is moving, but what kind of movement it is, and whether that movement represents real demand, real supply, or only the transfer of risk from patient hands to reactive ones. A market can move sharply and still offer no true opportunity. This is one of the hardest facts for a trader to accept, because movement attracts the eye before meaning reaches the mind. A stock may rise fast, fall hard, or swing violently through a level, and yet the important question remains unanswered: who is moving it, and why? Price is the visible part of the auction. Beneath it are motives. Some buying is patient accumulation. Some buying is only late demand rushing after a move has already become obvious. Some selling is deliberate distribution. Some selling is merely weak holders being forced out by pressure they cannot endure. The chart will show movement in each case, but the quality of that movement is not the same. This is why a trader must stop treating every advance as strength and every decline as weakness. A rise after a long, crowded advance may not mean fresh sponsorship. It may mean the public is finally convinced. A fall after a healthy rise may not mean failure. It may mean supply is being tested before the next serious move can begin. The surface action can mislead when it is separated from position, volume, and the broader behavior of the market. Location matters. A price move near the beginning of a constructive formation carries a different meaning than the same move after an exhausted run. A rally into resistance is not the same as a rally out of sound preparation. A break below a weak shelf is not the same as a brief shake beneath a well-supported area. The movement itself is only one fact. Where it occurs gives that fact its weight. Volume gives another clue, but volume must also be judged carefully. Heavy activity can show conviction, but it can also show disorder. A stock that rises on strong volume and then holds its ground is saying something different from one that rises on strong volume and immediately gives back the gain. In the first case, demand may be absorbing supply. In the second, excitement may have met stronger selling. The difference is not in the noise of the move, but in what remains after the noise has passed. The broader list must also be consulted. A single stock moving alone can attract attention, but leadership is rarely a private event for long. When serious demand enters a market, it often appears across related names, sectors, or leading issues before the crowd fully understands it. If one name is being pushed upward, while the rest of its group refuses to confirm, the trader should be careful. Is he seeing leadership or merely isolated promotion? The market often answers through comparison. The same principle applies to declines. A sharp fall in one issue may be important, or it may be local weakness. But when weakness spreads, when rallies fail across the list, when former leaders begin to lose support together, the character of the market is changing. Noise becomes more meaningful when it appears in pattern, not isolation. The trader who studies only one instrument may miss the behavior of the crowd around it. You should also watch how price behaves after attracting attention. True demand does not always announce itself with drama, but it tends to leave evidence. It absorbs reactions. It refuses to give back too much ground. It advances from areas where risk can be defined. Weak movement, by contrast, often needs constant excitement to survive. When the excitement fades, the structure collapses. because the move was carried by reaction rather than commitment. This is the market's method of transferring risk. Patient hands may use public enthusiasm to sell into strength. Stronger hands may use public fear to buy into weakness. In both cases, the visible wave is only the outer motion. The real study is whether stock is being absorbed, distributed, tested, or merely passed from one impatient trader to another. So when price moves, do not ask only whether it is up or down. Ask what the move has proven. Did it break from a place of preparation or from a place of exhaustion? Did it hold after attracting volume, or did it fail once attention arrived? Did related names confirm the behavior, or did they stand aside? Did the market accept the new price or reject it? These questions do not make the market simple. They make it less deceptive. Once you begin reading movement as behavior rather than excitement, you are closer to the real work. But even then, understanding behavior is not enough. The next test is knowing when the evidence is complete enough to decide, and when the wisest act is still to withhold judgment. A trader often gets into trouble before he ever places the trade. The damage begins when he forms a conclusion too early and then starts looking for reasons to protect it. A little strength appears, and he decides the market is ready. A small weakness appears, and he decides the move is finished. The evidence is still incomplete, but the mind has already chosen a side. This is a dangerous habit because once a trader decides too soon, he stops observing cleanly. He no longer asks, "What is the market showing?" He begins asking, "What supports what I already think?" From that moment, every minor movement becomes useful to his opinion. Facts that agree are accepted quickly. Facts that disagree are explained away. The market has not trapped him. His own conclusion has narrowed his sight. Good judgment requires a space between seeing and deciding. In that space, the trader remains free. He can note strength without calling it a buy. He can note weakness without calling it a collapse. He can admit that a setup is forming without pretending it is complete. This restraint is not indecision. It is respect for the difference between evidence and assumption. The market often reveals itself in stages. First there is a hint. Then there is pressure. Then there is confirmation, failure, or delay. The impatient trader treats the hint as the answer. The disciplined trader allows the sequence to develop. He knows that an early impression can be useful, but it is not yet a verdict. When you force a verdict from partial evidence, you make the trade carry more certainty than the market has actually given. This is where the question changes. You are not asking, "Do I like this idea?" You are asking, "What would have to happen for this idea to deserve action?" That question keeps the mind honest. It prevents you from turning interest into commitment too quickly. It also prevents you from rejecting a situation merely because it has not yet become clear. A trader who can define what is missing has not wasted time. He has protected judgment. Incomplete information should be handled as incomplete information. If volume is unclear, say so. If the general market is not confirming, say so. If the price is near an important area but has not behaved properly there, say so. This may seem simple, but it is rare. Many traders would rather hold a weak conclusion than sit with uncertainty. Yet uncertainty, when recognized plainly, is less dangerous than false confidence. The practical method is to divide your thinking into 3 parts. First, what is known. Second, what is not yet known. Third, what would change the picture. This keeps the decision from becoming emotional or premature. If what is known is not enough, you wait. If what is missing appears, you reassess. If the market does something that contradicts the idea, you do not argue with it. You remove the idea from serious consideration. Waiting, in this sense, is an active decision. It is not laziness, fear, or hesitation. It is the refusal to spend capital on an unfinished argument. The market will always offer fragments: a strong open, a sudden dip, a news reaction, a sharp recovery, a quiet pause. The untrained mind wants to complete those fragments immediately. The disciplined mind lets the market finish the sentence. This discipline also keeps you from becoming married to a forecast. A forecast is only a working thought until the market confirms it. If you treat it as truth too early, you will defend it when you should be testing it. If you treat it as a possibility, you can update it without pride. The best decisions come from a mind that is prepared, but still flexible enough to be corrected. So before you decide, slow the judgment down. Name the evidence. Name the missing piece. Name the condition that would prove the idea stronger, weaker, or invalid. The trader who does this is not trying to predict every wave. He is trying to avoid being ruled by the first wave that looks convincing. And once decision-making becomes this deliberate, the next question is how to build a daily working life that makes such clear judgment easier, not harder. A trader does not meet the market with a blank mind. He meets it with whatever he has allowed into his attention before the bell. If the morning begins with scattered opinions, sudden headlines, random charts, and the restless habit of checking everything, then the trading day has already been weakened. The market has not even opened, yet the trader has made himself available to noise. This is why professional habits matter. Not because routine is impressive, but because routine protects the trader from unnecessary influence. A man who has no fixed process is forced to decide what matters while the market is already moving. He jumps from one symbol to another, from one opinion to another, from one time frame to another. His attention becomes crowded, and a crowded mind cannot judge cleanly. A proper routine narrows the field before pressure arrives. It says, "These are the markets I will study. These are the stocks worth watching. These are the levels that matter. These are the conditions under which I will become interested." By doing this work early, the trader reduces the number of decisions he must make in the heat of action. Fewer decisions made under pressure usually means fewer mistakes disguised as opportunity. The purpose of preparation is not to predict the day. The purpose is to know what kind of day would matter. If the general market is firm, certain names may deserve attention. If the market is heavy, the same names may require caution. If price opens far from the level you studied, that fact must change your behavior. A prepared trader is not surprised by every movement because he has already considered the territory in which movement would become meaningful. This requires deliberate exclusion. You cannot follow every stock, every commentator, every rumor, and every sudden mover without paying a price. The price is not only confusion, it is dilution. When everything is on your screen, nothing has priority. When every voice is allowed into your ear, your own plan becomes faint. The professional does not need more information than he can use. He needs the right information arranged in the right order. That order begins with context. Before studying individual action, look at the general condition. Is the market advancing with broad support or rising on narrow participation? Are leading groups acting well, or are they losing character? Is risk being rewarded, or is strength being sold? These observations create the frame. Without the frame, individual movement can appear more important than it is. Then comes selection. A watch list should not be a collection of interesting names. It should be a working inventory of situations that meet specific standards. Each name should have a reason for being there. Perhaps it is near a meaningful level. Perhaps it has shown relative strength. Perhaps it is forming in a way that deserves observation. If a stock has no defined reason for your attention, it becomes another door through which noise can enter. The trader should also decide what he will ignore. This is a serious habit. Ignore moves in names you did not prepare unless they connect to your actual work. Ignore opinions that arrive after price has already moved. Ignore dramatic language that adds urgency but no evidence. Ignore the desire to rebuild the entire plan because the first hour feels lively. A trading routine is valuable only if it keeps you from being recruited by every new disturbance. During the day, the routine should remain simple. Return to the prepared levels. Compare the action with the conditions you wrote down. Mark what is behaving as expected and what is not. If nothing meets the standard, then nothing is required. This is not wasted time. It is the routine doing its job. The absence of action is acceptable when the conditions for action are absent. After the day closes, the routine should remove argument from memory. Record what was planned, what actually happened, and where attention was pulled away from the work. Do not turn the review into self-punishment. Use it to identify the leaks. Did you watch too many symbols? Did outside commentary change your focus? Did you abandon the prepared list for whatever was moving fastest? These are not small details. They are the channels through which noise becomes habit. A trader who builds this kind of working life does not become immune to market disturbance. He becomes less exposed to it. He knows where to look, when to look, and what deserves his attention. That structure creates steadiness before the trade, but once capital is committed, the challenge changes again. Then the question becomes how to listen to the market without letting every fluctuation interfere with the position. A trade changes the moment your capital is inside it. Before entry, price is only information. After entry, the same price movement begins to feel like judgment. A small reaction appears larger. A pause feels heavier. A normal test of support can seem like a warning. The market has not necessarily changed, but your relationship to the market has. This is why managing a position requires a different kind of listening. Before the trade, you are deciding whether the evidence is strong enough to act. After the trade, you are deciding whether the evidence still supports staying. Those are not the same question.